Variable annuities for the national portion of the life insurance exam differ significantly from fixed annuities because the insurance company shifts all the investment risk to the contract owner. When you see the term variable on the exam, you should immediately think of the separate account. This is a distinct account where the premiums are invested in equity-based products like common stocks, bonds, and mutual funds rather than being held in the insurer's general account. The insurer's general account is where they keep the funds for fixed products to ensure they can meet their guaranteed obligations, but the separate account is strictly for the benefit of the variable contract owners and is kept completely isolated from the insurer's general assets. The primary reason a consumer chooses a variable annuity is to provide a hedge against inflation. Since the value of the account is tied to the performance of the underlying investments, it has the potential to grow at a faster rate than the cost of living increases. However, the downside is that there is no guaranteed minimum return, and the owner could actually lose their principal investment if the market performs poorly. This lack of a guarantee is exactly why variable annuities are categorized as securities in addition to being insurance products. On the exam, you will likely be asked about the regulatory oversight for these products. Because they are securities, they are regulated by the Securities and Exchange Commission and the Financial Industry Regulatory Authority, better known as FINRA. To sell a variable annuity, an agent must hold both a state life insurance license and a federal securities license, such as a Series 6 or Series 7. You must also provide a prospectus to the client at or before the time of sale. This document is a legal requirement that discloses all the fees, risks, and objectives of the separate account and ensures the consumer is making an informed decision. A common exam trap involves the units used to measure the value of the contract during different phases. During the pay-in or accumulation phase, the owner buys accumulation units. These represent their ownership interest in the separate account, similar to how a person might buy shares in a mutual fund. The number of accumulation units grows as more money is contributed. Once the owner decides to annuitize and begin receiving payments, these accumulation units are converted into a fixed number of annuity units. While the number of annuity units remains constant throughout the payout phase, the dollar value of each unit will fluctuate based on the performance of the separate account. This means the monthly check the annuitant receives will change in amount every single month based on the underlying investments. To help you remember the difference between fixed and variable products, use the phrase variable is volatile. The V in variable stands for the volatile nature of the separate account and the fact that the value is always in motion. Another point to watch for is the death benefit. Most variable annuities offer a death benefit that guarantees if the owner dies during the accumulation phase, the beneficiary will receive at least the amount of premiums paid into the contract, even if the account value has dropped due to poor market performance. Do not confuse this limited death benefit guarantee with a guaranteed interest rate. When the exam asks who bears the investment risk in a variable annuity, the answer is always the contract owner. This is a fundamental concept that distinguishes variable products from fixed ones, where the insurer bears the risk. Furthermore, suitability is a major focus on the exam. Producers must ensure that a variable annuity is appropriate for the client's financial situation and long-term goals because of the market risk involved. You should look for keywords like growth or inflation protection when identifying why a client would want this product. You should also be aware of the assumed interest rate, which is a benchmark used to determine the initial payment amount and how subsequent payments might change. If the separate account performance exceeds the assumed interest rate, the next payment will increase. If it is lower, the payment will decrease. Understanding the distinctions between general and separate accounts, the dual licensing requirements, and the transition from accumulation to annuity units remains a top priority for candidates aiming to pass the national portion of the insurance licensing exam.